This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. Of all the left tail scenarios you're forced to ponder when you work in financial markets, a Middle Eastern war that leads to the closure of the Straits of Hormuz is one of those that always gets brought up as something to be feared and, ideally, avoided. But so, 2 weeks after the first airstrikes by the US and Israel on Iran, that seems to now be our reality, with no clear path forward. In response, we've of course seen wild gyrations in global energy markets and a sharp rally in the US dollar, both of which challenge what had been widely held consensus short views at the start of the year. And second-order risks are now emerging as regional oil producers cut production and refining capacity in order to avoid a glut of oil that has nowhere to go. Yet an optimist would also point out that global equity markets have been pretty shallow in their corrections. Rate markets are already calming down, and as we record this, volatility is starting to retreat, albeit at not quite the pace it was spiking earlier in the week. So it's helpful for me to be able to lean on one of my favorite experts on geopolitics and its intersection with markets. That, of course, is Elliot Hentoff, Chief Macro Policy Strategist at State Street Investment Management. Elliot, welcome back. How you doing?
Boy, what a week it's been.
Having worked through quite a lot of these, I don't think I can recall one that is as complex and as fast moving and as disorienting as this one. Am I crazy for saying that?
I think this one is even more than Ukraine, Russia. There is so much expertise that's in the military domain that is alien to us.
Yeah.
And that we basically are feeding off of. And I think that makes this quite unusual because it really, the variables that matter for markets really comes down to evaluating this aerial warfare, of which obviously none of us have serious expertise.
Yeah.
The economics and finance part is easier.
Yes.
Actually, in many ways, that's almost textbook. But the actual analysis of the war is much, much harder.
Well, shall we try?
Yeah, let's go ahead.
We tend to only do these conversations when things are going wrong in the world, so I apologize for that. In fact, I think the first time we had you on was just after October 7th, which I had to look and couldn't believe was nearly 3 years ago. You gave me a framework that I referred to time and again ever since then about the ways geopolitics affect markets and the channels through which it does. And there are 4. There were the sentiment channel, trade channel, capital flows, and then just the macroeconomic channel. Assuming that so far what we are seeing is mostly a sentiment shock, albeit one where terms of trade for commodity producers are very much in flux, how close are we and how realistic is this to becoming a macroeconomic shock?
The channels you're describing are when you're talking about individual events like this one. But I think even more useful is really to take a step back and look at the canvas. In our last conversation a few months ago, we spoke about just what does the changing world order mean for investors? And at a very basic level, it's exactly what we're seeing today, which is you have a fragmenting world. A fragmenting world means you have friction between global powers. That friction expresses itself in wars. It expresses itself in trade wars. It expresses itself in sanctions and competition for resources and so forth. That, in turn, basically damages the global supply side of the economy repeatedly, either in the form of supply shocks that we see today or distortions. And how do states respond to that distortion or disruption? The fiscal arm has to step in and kind of mitigate, buffer, help fix it. And as a result, what you get is really a fiscal cost that shows up in different bond market profiles. And that's basically exactly what we are seeing right now. So that's how it obviously happens. It happens, primarily through kind of terms of trade channel and expectations in that end, a little bit exacerbated by sentiment. But the end result is nonetheless the same, which is that, overnight, the prospects for heavy energy users or energy producers look very different. And those change prospects have to get repriced. Particularly for importers, that means a cost that's being incurred that will be priced in now, even though it's a future cost.
I wanted to talk about scenarios that you see as likely, and I particularly want to eventually get to how we possibly de-escalate from the scenario you've laid out of the energy cost that's now being imposed. But the conflict itself, given we are now about 10 days into it, by the time this goes out, it'll be around 12 days into it, a sort of state of play and thinking about, we don't predict the future here. We can't do that. But what scenarios you see on the ground as being most likely for the coming weeks of this conflict and how you're kind of probability weighting them?
I actually do not think there are that many scenarios. It's a range between two outcomes. One is a scenario where within a reasonable time frame, the Iranian threat is shrunk down to size that the US feels satisfied, and basically can declare the mission over, then allow, and in that, through the shrinkage of the Iranian threat, they're able to basically enforce a reopening of energy and shipping lanes. That's one scenario, and that's obviously the bullish one for markets. Longer term, that has huge geopolitical implications if that actually succeeds like that. The other end of the scenario is one where you cannot shrink the Iranian threat down to size within 3 to 4, 5, 6 weeks. It takes longer. And in that scenario, basically, either the US accepts that, calls for a truce, allows the Iranian threat to be shrunk but still somewhat intact, basically survives another day, has the opportunity to rebuild, or it allows the war to drag on for longer. And then obviously the global macro shock is bigger. Those are the two scenarios really in play. There's some more extreme ones kind of on the bullish end where you basically get a regime transformation happening much sooner, or even a more shocking revival in Iranian military supply via Russia and China, and therefore the war effort actually manages to escalate. But those, I think, are kind of peripheral. I think the core ones really, you get a reopening and a stabilization of global energy within a reasonable time frame. Let's call it 4 weeks, plus minus one, or you do not. Those are the two outcomes.
Going to your first one, when you talked about declaring the mission over, I mean, we sort of went through this a little bit with the Iraq War, where 3 months into it or however long it was, the declaration was mission accomplished. And I'm wondering if you can talk about the differences between the ability to do that now versus then, and whether it is as fanciful an idea of doing that now as it was then.
Let's differentiate here. From a financial markets point of view, the Iraq War did end just weeks after it began. I don't want to diminish what came afterwards militarily and from the humanitarian point of view, but from a markets point of view, it really did end very soon. And similarly here, you could have a fighting that goes on for longer, but that does not necessarily mean it's macroeconomically relevant. So that distinction matters a lot. The second point here is, as long as there's no troops on the ground inside Iran and there's no direct combat, it is easier to just declare mission over and basically say, well, I'm going to stop shooting. Let's see whether you stop shooting. And so that dynamic is much easier to implement than to kind of draw kind of a ceasefire in a live physical battlefield like Eastern Ukraine or the Iraq War back then. And then the third point is, even from a strategic point of view, because this is not about necessarily taking out the regime, just saying, well, we've basically reduced the threat potential down to a certain, it's below a certain threshold, call it the threshold of tolerance, pain tolerance. We can basically walk away and we can almost leave the field to others to deal with it. That's also feasible. Again, this is all, it sounds messy. In many ways it is, but from a market's point of view, that can still be a clean exit. And it's operationally probably is much more feasible than, there's nothing physically stopping that. Whereas, once you have ground troops in play, it becomes much more difficult to kind of withdraw and have an exit strategy.
And that brings to mind as well the question of the domestic population of Iran. And, we're not very far removed from the domestic unrest there. And the way that was put down, and, the Trump administration talking about this being Iran's opportunity, or the populace of Iran's opportunity. I mean, what part do you expect them to play? And what is the context there for this conflict and its resolution, and the future governing structure of Iran?
In the near term, that's market relevant. And we've seen the Iranian regime respond by elevating Khamenei's son to the position of supreme leader, despite not being an Ayatollah formal rank. So that's kind of in contravention of its own constitution. It's also a clear signal to the US and Israel that this regime is not open to a diplomatic pathway out of the crisis. So it basically implies the regime it will have to be decided on the battlefield. It will have to be decided between drone and missile launchers and the ability of air defense systems and offensive capabilities of taking them out. That's what's necessary. Beyond that, how the regime evolves, the reality is that authoritarian regimes that lose wars tend to be very fragile in the aftermath. That's not always the case, but the literature is clear that an overwhelming number of authoritarian governments tend to struggle to impose their will after losing a war, particularly losing one badly. We basically saw that last year. Iran had a fairly heavy blow in the 12-day war against Israel, and within a few months, you had the largest protest wave sweep the country. Those two are not dislinked. Iran has a multitude of crises going on. Obviously, right now, militarily is a war, domestically, politically, disorder. You have an environmental crisis. There's serious talks of the need to basically evacuate Tehran and resettle elsewhere. There's an economic crisis, inflation in the high double digits chronically, perhaps a reduction in foreign revenues and income. These multitude of crises do not speak for a system that sustains itself stably. Well, now, for markets, what matters here is, does that bubble out and express itself as spillover risk into other countries the way we're seeing it right now, literally rockets spilling out of the country? Or does it speak more to kind of an implosion and an introversion where all these tensions and pressures start to pull forces inward in trying to work that out? That remains the question. It's obviously very extremely unlikely you'll have any type of smooth, any type of democratic transition, possibly even any type of visibly cosmetic transition at the top. It very much looks like the regime is clinging on to its old established playbook until the war is over, and then gradually it may internally reform and morph just in order to kind of restore stability. But that could be a sadly very, very messy process for the domestic population.
Well, thinking about, and you mentioned the region and how this is spilling over, and it's particularly the effects are being seen in markets, and I think through the macro channel. When you look at unleaded gas prices in the US, there's been an immediate macro reaction to this through the energy channel. And that's where I wanted to talk about next in terms of kind of the short term impacts. We will get to the long ranging forces in a moment. But the closure of the Straits of Hormuz and taking production offline in various countries as a means to be able to store it because it can't be transported, it has created the choke point in the energy market that has been worried about for decades, really. How long do you see this as possibly extending? How meaningful is the closure now, and how meaningful is the possibility that it can extend for weeks, if not months?
That's the key market question. On the first day of the war, my first research note started off with it. This is the worst case. We have full-on regional war. This is as bad. This is the scenario we were all terrified about, and markets were taking it relatively calmly. That which surprised me at the time. It all comes down to the duration of the closure. As you pointed out, the longer it gets closed, the Straits of Hormuz, the closer we approach the limits of storage. That means producers then have to decide, oh, when do I reduce production or shut it in? Iraq has already done so at the time of this conversation, the UAE and Kuwait have also signaled that they're reducing production in order to buy themselves more time until they hit their storage limit. This is all very acute, but it really does not matter much if we get a prospect of quick de-escalation, even if it comes after these fresh, these critical markers. So let's say originally we had anticipated, the straits being closed for 2 weeks, 3 weeks max. You would start to have serious production cuts all across the Gulf, meaningful. We're talking between 4, 6, possibly 8 to 10% of global production. That's obviously unprecedented, and oil prices will respond in kind. However, I do want to remind everybody here that if you then get rapid signs of de-escalation, a lot of the risk premium melts away, and that can be up to $20 a barrel. Plus, global supply demand dynamics will adjust as well, and so you'll get not a full, but you could get a partial normalization in prices very, very quickly upon de-escalation. So the snapback can be relatively rapid. It does not mean you go to the day before the war, but you go back to a level where it's no longer a huge burden on the global economy, and it diffuses a macro shock. It basically, you have energy as a little bit of an inflation driver, not what you just described, where you can track week by week the high single digit increase at the pump. So that's very much possible. So my personal expectation is that we probably will get to a stage where the storage limits fill up, production cuts become implemented, but I don't think that lasts for very long. If you had to force me to give you a number, I really do think we're speaking about weeks and not months. But that's a critical question, and obviously that matters. I want to respond also, or get ahead of this conversation, because you mentioned inflation. Let's think about what are we talking about in practice. So let's say, because we did this modeling exercise earlier, oil prices go up $50 a barrel from when they were January 1st. They stay there for 3 months. What happens to inflation? That would mean roughly oil at 115 for the duration of 2-3 months. Well, then you have US CPI up by about 1% for the following 3 quarters, roughly. That gives everybody a sense. That's obviously a meaningful material change in the inflation outlook, but it's also not a disaster either. And so that's the context. And again, that does require kind of this crisis, the closure, to be prolonged, probably beyond 3 or 4 weeks to achieve that. So I would still take the under on that, and therefore on the inflation outlook also assume that you do get a serious jump upwards in US and European and Asian inflation and emerging markets too, everywhere, but that it is probably half that scenario that I just painted.
There's a follow-up to that I want to come back to about the policy response that we might see. But before that, actually, and this is a nice means by which we can talk about not just some of the short-term events and the market reaction and how this is all getting digested and priced for, but the longer-term questions of inflation in particular. We have in the background, of course, a potentially very disinflationary force of technology, which we've done, I think, probably half of our podcasts this year have touched upon the disinflationary potential or even deflationary potential of technology through labor markets and through productivity. But now we have this situation of geopolitically driven inflation. And in as much as it might have kind of a few quarters worth of effects, we have a flashpoint by which these shocks can occur and maybe can occur more frequently. Thinking about it strictly from the long term, not the kind of the Fed's inflation forecast for the end of this year, how do you see the balance between those two? What is your longer term structural bias for price formation as these two competing forces kind of fight it out?
That is such a profound philosophical question,
I try.
because we because we've tried to put numbers to this. I would definitely say that pre-November 2022, ChatGPT's release, we were firmly in the camp that you when you look at geopolitics, demographics, some other slow-moving factors, that they were all overwhelmingly inflationary. And then at the time, we thought the disinflation emanating from technology would be less than that. I think that's harder to justify and argue for given the rapid advances in AI. So I think it's a time frame question. I do not believe we are going to live in a fragmenting geopolitical world for that much longer. I've mentioned this before in a previous podcast. We're in a transition period. Transition periods last 10 to 20 years. Eventually, you get a restoration of some global equilibrium, hopefully absent wars even bigger than the ones we've seen. Eventually, either a hegemon or a balance of power sets in. During that period, I do think the disruptions probably are still outweigh the gains, the productivity gains, and the disinflation that comes out from this really new powerful technology. And over time, the forces of AI will make themselves felt. So I would probably say the closer we look, the more the inflation dominance prevails, the further out on the horizon it starts to flip.
I mean, that's been the really interesting market reaction, specifically over the last two trading sessions. And here we are kind of focusing back on, again, on the short term round now. And I wanted to start to think about the policy response to this, both monetary authorities and fiscal authorities, but specifically on the question of inflation. And, the classic macro response to this is you look through it because it's an energy driven, supply shock driven event that you can't do anything about. And yet we have market pricing for tighter policy from various central banks in Europe without a continuation or a furtherance of the Fed pricing getting more aggressive, given it's likely to be a bit of a growth shock for the US. How realistic is the lack of dovish pricing to a growth shock vis-a-vis the question of whether these guys will actually hike or not? Is hiking realistic, say, for the ECB?
It comes back down to where we started this conversation. How do you evaluate the drone missile efficacy of Iran over the coming 3 to 4 weeks, or possibly 6 to 8 weeks, and so forth? I laid out my core scenario, which I genuinely do think that at the latest 6 weeks from now, energy's flowing relatively unimpeded into the global economy. And in that scenario, you're right. If I'm a central banker, I think it's very hard to justify what is, well, then, even though the transmission hasn't even happened fully, but then you can already see kind of the negative impact and then the kind of the de-escalatory impact feeding through your inflation picture. And I think it's very hard to justify hiking into that. I do not find rate hikes credible unless, again, I'm wrong. 4 to 6 weeks from now, we're still facing a completely closed Straits of Hormuz, Iranian drones flying with the same frequency and intensity as they have been in the first 10 days of the war. Then I'm wrong. But otherwise, my core scenario is rate hikes are off. I think therefore, for when I look at the bond market, for me it's a fiscal story, and the fiscal story, even if you know there's de-escalation coming, there's going to be a cost incurred. There is a shock that has happened, is unfolding, and will accrue greater and greater costs until the shock unwinds. That has to be borne by some agency somewhere. Fiscal will step in to mitigate, to buffer, to lessen that impact, and that has to be priced. And to my mind, the long end of the curve in basically developed sovereigns has to rise. And obviously, I'm a big term premium bull, so to speak. It feeds into our overall view that the term premium generally still has ways to widen.
And what form does that take? Is it more demand-oriented measures that, are just stimulatory in nature in response to slower growth? Or is it somewhat what we saw during the Ukraine war, particularly here in the UK, where you had direct subsidies to households because of high energy costs? What do you think is gonna be the response or the nature of the response, I guess?
Well, it's a mix. It's going to be on the margins, or not on the margins. There will be some emergency measures to protect certain balance sheets, whether that's households in certain very gas-intensive countries where we know there's the LNG outage is continuing to lead a very severe spike in gas prices. But it will also be stimulative measures, and particularly the idea that we've hit a ceiling in any way on the required defense costs that are accruing is ludicrous. I just keep on encountering investors who say, well, defense sector is already it's overvalued. Its projections are excessive, and I think this is basically you have to think of it as another bump up in the demand curve for defense products. This time, I think the biggest lesson here is what do air defenses look around the world? And to be honest, outside of the Gulf, Israel, they look quite spotty. So that market will have to grow, and somebody's going to have to pay for that. That's another form of fiscal that will have to be baked in. Again, the magnitude really depends on how this war unfolds over the next few weeks.
It's an interesting place to go. You mentioned the Gulf states because they've been spending. Looked at the UAE's defense spending as a percent of GDP. I think it's about 3.5%, if I'm not mistaken. They are getting pulled into this conflict, and I wanted to talk about the region and the alliances within the region, and particularly both the formal and informal ties that you see, whether it's the U.S. and Israel or the U.S. and its other regional allies like Saudi Arabia, UAE. How strong do you think those forces will be throughout this conflict? And are there any strains that you can potentially see opening up among?
It's a very simple maxim. Victories beget deeper alliances and better friendships, and losses do the opposite. So I hate to deliver a cop out here, but ultimately, power has a magnetism, and when exercised successfully, draws people in or draws states and partners in closer. So if the US emerges with the perception that it deployed US power effectively, I think that will be very alliance supportive. And conversely, if it looks like this backfired, this whole undertaking was costs imposed on allies was greater than the benefits generated, the countervailing will be true. The greatest example of how you can misallocate power is Russia's invasion of Ukraine. Russia has lost all sorts of geopolitical allies in its network because it didn't have the resources anymore to support them. Couldn't support its friends in Syria, in Venezuela, probably now in Cuba as well. It could not support Iran during the 12-day war meaningfully. We'll see whether they can do so now, which is where I'm somewhat skeptical, but I do not rule it out. And so that's when power is shown to not be effective because Russia got bogged down in a really misconceived invasion of Ukraine. So the outcome really will determine that.
That then brings me to what I think for me is one of the more important parts of this. And it is kind of the elephant in the room when you talk about great powers. We haven't talked about it on the podcast just yet, is China. You mentioned losses of allies in Venezuela, now in Iran for Russia, but that is, of course, also the case for China. And their response so far has been not as vocal as maybe I would have thought, but perhaps I'm maybe missing something. And that's why I'm asking you. I mean, first of all, taking a step back and thinking about it from the US's perspective, where does this particular conflict fit, if it does at all, within the US's national defense strategy vis-a-vis China?
That is the right question. That you're almost taking a historian's view. Where does this conflict sit in the great arc of history? And when I spoke earlier about this transition period, we're obviously in the transition period between what is the accommodation that the US and China will find with each other in the global stage over the coming years. And this war is at the center of that. I think there's two areas of competition here. One is the Chinese have demonstrated escalation dominance over the US during the trade war of 2025. They've clearly shown that China possesses the upper hands in a variety of domains that's key manufactured capital goods that are critical for civilian and military infrastructure and products. They've most of all shown that in rare earths and critical minerals and the refining capacity, they control that choke point over the US and everyone else in the global economy. So the US obviously reeling from that experience is one could interpret some of the moves recently as a reassertion to show where the domains where the US still maintains dominance, which obviously one is the area of finance and the use of the dollar. The other one, of course, is military. military force and the power projection is a key one. And therefore, it's in many ways also a risky gamble because, again, if the war is successful, this reaffirms the point. If it's not, it diminishes that point. But it also touches on a different area, a different domain, and that is energy itself. Clearly, the energy strategies of U.S. and China are so opposite to each other. The U.S. basically pursuing a fossil fuel heavy, maybe possibly even fossil fuel centric energy strategy, of which they can leverage their huge natural resources of their own. And I have to remind people, huge natural resources in the Western Hemisphere as well. So together, a formidable energy bloc that is shaping up. Now, think about the Middle East conflict. In that context, this would be the assertion of US power over that region, directly or indirectly, would basically extend that dominance in the energy domain. And China, of course, has mitigated that by very much driving an energy transition, a shift away from fossil fuels, a shift away from energy imports overall, and basically reducing its vulnerability and exposure to that. So that's one way to think about this conflict. It's the geopolitical tussle over different domains. And the second one, of course, is more kind of classic geopolitics, which is what is the credibility of US or power in East Asia, specifically around Taiwan and East Asian allies? This conflict will very much determine that. Does it succeed and allow the Middle East to basically self-regulate? In plain English, Iran's threat is so decommissioned that the US can vacate the region, leave it to its allies, the Saudis, the Turks, the Israelis, to say, okay, you manage the region on your own. We are no longer needed, and allows basically the pivot to Asia. That is basically also the theme in Europe. Remember, the whole theme is we don't want to be involved. We want a peace in Ukraine, Russia, or we don't want US assets being deployed because you Europeans are wealthy enough and you have the resources to do that on your own. And that would free the US up to pivot. That is basically the gamble here. And obviously, if it goes wrong, quite the opposite happens. The US gets mired with a continued overcommitment to the Middle East, which has kind of plagued it for the last half century.
With that in mind, then, and appreciating that it's impossible to really do this, but if you were to put yourself in China's shoes and think about their restraint so far, clearly restraint from action, but also restraint from commentary, even. What explains that in your view? And how do you potentially see their calculations changing vis-a-vis Taiwan as a result of what they're seeing? I'm more interested in kind of their psychology as to why they have been a little bit more restrained than I would have imagined, both in response to Venezuela as well as this particular instance.
I think we should be very humble in not projecting our worldview and our expectations of how our governments conduct foreign policy onto China. I think China has shown that it, in every area, whether it's how it runs its economy, its financial system, its foreign policy, it does it in its own way. It has a very justified logic for doing so. So what you may see as restraint can also be seen as prudence. Yes, China doesn't have allies the way the US has had allies or alliances. And some in the West will easily say, well, that's a weakness, that's a shortcoming. Then again, it also has no liabilities that come with that. It doesn't have a variety of exposure that sinks with the Iranian regime. It had a very nice modus vivendi where it was getting discounted energy, and it also dominated a small emerging market in its partnership with Iran, and one that also kind of extracted political and financial military capital from the West. That was a nice arrangement, but it was transactional in a way where they can walk away from it cost-free if they want to. And so I think it's a different way of conducting world affairs. There's arguments for it, and to some degree it sounds prudent. And just think about all the resources they have saved not being involved or too deeply enmeshed with any of their partner governments around the world. It obviously goes both ways. It also means that, if you're an ally or a partner of China, that in a moment of crisis, help may not be forthcoming. So it does cut both ways. I think the other way to think about this is same way in the prudence. If I'm in China, well, my God, the US is very busy all around the world. It is really burning through not only cash, but resources at an alarming rate. It's also possibly draining its own political will to be active. That's been kind of the story of the last 20, 30 years. And perhaps we just carry on letting this play out and allowing for those natural forces to, empower our relative standing simply by virtue of the US being busy and preoccupied and retrenching for a variety of reasons. So it's a kind of a note of caution here to not make any presumptions.
Very much a focus on the long game, potentially, but we're gonna try and bring this back to the short game just to close things out, and, I've read some of the notes you've written already in response to this, and you always finish quite clearly with what you're looking at and the things you're keeping your eyes on, and I wanted to ask about that just to close. I mean, for the coming days, weeks, potentially, what specific developments, areas of the region, economic indicators, market indicators, what are you looking at as a means of getting a better sense of which way the kind of outcomes you've outlined at the beginning, which one of those two has the higher probability of being realized?
The first is the obvious one. What is actually happening with production? Is it getting hit? Are there infrastructure reasons for why production gets reduced? At what pace it gets reduced? How permanent is the reduction? All of those classic core energy. To what degree do energy transport pathways relax, reopen, divert? So that's I think very, very obvious to all the listeners. But then when you think about it, it's the stuff that's further down the pipe, literally further down the pipeline, that one has to think about, which is, well, what about those diverting pathways? Are those at risk? Will the Houthis enter this war? The whole point is that we can divert up to a third of the Straits of Hormuz via the Red Sea bypass at Yanbu, but the Houthis are right next to there. Do they start launching a drone warfare and closing off that as well? That obviously will exacerbate the spike. And so that's big question mark. The other one is, well, outside of energy, does anything else happen that really will dramatically escalate or change the situation? I dare to say it, but damage to some critical non-energy infrastructure. Imagine major desalination plants get hit in the Gulf, and there's a severe water shortage for the civilian population. These are all obviously frightening scenarios that one has to consider, but obviously they would change the outcome. And the other ones are more mundane, which is, how is the energy shock managed policy-wise, particularly among those countries we have in the OECD. We have a collective reserve system of emergency stockpile of energy. China has the largest one actually right now. Does China or the OECD, to what degree do they release some of their strategic oil reserves to mitigate what looks to be somewhat, in some shape or form, a temporary outage? Obviously, hypothesis remains tested. But those are the things to really critically look at. I'll finish off just with one real investment takeaway, because I do want people to be able to go back to their screens and position, which is that in virtually every geopolitical crisis where energy has spiked, the moment oil peaks, bond yields drop right after. And so that is a maxim that holds true. It's held true every single time. And so if you think we've gotten to the moment where this is it cannot get any worse, well, that's the time to be buying bonds again. There will not be a full retrenchment back to the start of the war, because I've mentioned there's some fiscal costs that pile up, but a lot of that extra yield will melt away, and that's an opportunity.
So for the short term, you won't be obsessed with term premium then.
There'll be a short-term relaxation in our investment committee.
Very good, very good. Well, we can't stay relaxed over here. We were thinking about doing this last week, I didn't want to rush things out. I'm so glad I waited because we got the longer term perspective and we got the sort of short term things to look at. And we got the perspective of Elliot Hentoff, who's joined us, I think, for now the fourth or fifth time, Elliot. We'll try and have you back on when things are better, maybe, like when the Board of Peace meets or something. But I appreciate you doing it this week.
Thanks so much. I do look forward to the happy occasion, getting an
Yes.
invite.
Yes, absolutely. Thank you so much. Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. State Street Trust Company, hereafter referred to as State Street, and is for informational purposes only, and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.